Welcome back to the Atomic Level, the show where we decode the matters of wealth, one insightful conversation at a time. And then once every week on Wednesdays, we do office hours and AMA, Ask Matt Anything, our little nuance of Matt Chats. Matt Meuli here to talk through the questions that come in through the week on everything related to asset protection, estate and legacy planning, and everything in between as it relates to protecting both your net worth and your net happiness. So as you know, I'm Chris Snook. As you join the live room, thanks for being here. We're going to dive right in with Matt. The one thing to always start off with is our famous disclaimer, which is Matt is an attorney and he operates in Wyoming and in Colorado, and he's got networks in other states, but he's not yet your attorney. Potentially, he may be your attorney. And if he is, he's grateful. But if he's not your attorney, this is not legal advice. This is education and conversation starters and things that you should take seriously and consider in your plan, and then talk with whomever your preferred counsel is. If you're looking for counsel, if you like something that Matt says, if you'd like to work with us or pick his brain on some ideas, human beings answer the phone. Colorado residents can dial 970-820-0090. And if you're looking at some of the more advanced architecture strategies, holding companies, Wyoming asset protection trust, things like that, which we talk a lot about at length for small business owners, then if you operate in any of the 50 states, you can call 307-463, man, my eyes this morning, 3600. That's 307-463-3600. Matt, that is the disclaimer. Welcome back to another Matt Chats.
Well, thank you, Chris. It's great to be here. Always enjoy these Matt Chats. Just where they're going to.
You're back from a week off. We had Owen here last week. He and I went down the rabbit hole of a lot of really interesting stuff related to NIL and digital assets and property and family governance and all kinds of things there. So he did a good job in your stead, but we missed you. We're glad to have you back from your big conference down in Denver last week. And tell us about it. Like, what was the key takeaway? What did you were with several hundred lawyers talking about the greatest transfer of wealth in human history, which we've been writing a ton about. What did you take away from that?
Well, just the responsibility that comes with that great amount of wealth to try to get it to the next generation, and some of the strategies to do that. One of them was just basically for the wealth owner, the wealth holder, to get a family meeting together with their kids and to be a good steward of that money, and just to start sitting down, once a week, just starting to discuss what it is, what's the ownership structure like, the reasons behind it, and all those things that you are hesitant to discuss with your kids and things like that. And one of the things where it was brought up in the conference was you can even discuss how the wealth is invested in the public investments and things like that in the stock market, and what kind of companies, and do these companies actually align up with your values? Are they supporting causes that you don't believe in, and things like that, and how that, that stewardship can even get more granular. I'd be looking at, hey, let's only invest in these type of companies. One of the ones where restore the planet instead of, use the planet up, and those kind of things. So a lot of conversation starters and those kind of things to talk with your family, be a good steward, and just kind of say the purpose, what's going on, why you do what you do, and why you invest in what you invest. And I think, the bottom line that gets everyone interested, kind of removes some of those entitlement feelings and just gets everyone involved, because now they know that they're taking over something, not just assets, taking over more of a philosophy or a vision, if you will, to continue the family dynamics and the family philosophy throughout generations.
Yeah, and so we're going to get into some questions that came in. I'm sharing the screen just for a visual for those who are watching this on replay or what have you. I wrote a piece with Ben Reinberg this week, part of a 10-part series that we're doing on the Alliance Intelligence newsletter side of things, which is one of my properties that I contribute to, and Ben does a great job with. But this great rotation concept that they came up with and that we did some research for is all about kind of how that wealth moves, right? Because it's one thing to say whatever the number is, 124 trillion over the next 22 years, 5 trillion a year. Like, what's a trillion here? What's a trillion there? It's a lot of money, a lot of wealth, moving hands, right? but how it moves and then what happens as it gets re-underwritten each time it moves is kind of the thing where the planning really starts to show up. So we got a lot of questions in that I want to address this week, specifically from the 7,800 people who read this piece since yesterday morning. More will probably come in. So I wanted to spend the time talking about some of the audience questions that came in off this piece. I'll put the link here in the chat for anyone who's interested in reading that piece um, for context. But some of the questions, we'll just start at the top that came in after reading this, because there's a lot of portion in that talks about how the money moves horizontally before it moves down in a lot of cases. And so there's this kind of multi-step re-underwriting of the asset base that can happen. And that also means there's a multi-step way where it could be confiscated or leaks or just, lost, like things that happen because that family conversation wasn't had, the planning doesn't support everyone's assumptions or alignment. And so these are the questions that kind of were top of people's mind as we got through that today. So one of them is, most families focus on minimizing estate taxes when they're planning, but what are the three biggest risks that destroy family wealth even when taxes have been planned for properly? So assume that they've got that tax plan kind of nailed down. What are three or four, whatever the right number of risks are, that could destroy the family wealth or cause issues, even inside of that estate plan being kind of properly executed?
Yeah, I mean, the estate tax is definitely one of the aspects that you wanna plan for. There's an exemption for estate tax, where you don't have to pay any estate tax until your estate exceeds 15,000,000 in value. So, that big number sometimes takes care of a lot of the estate taxes for people because they don't have that much. So there's ways to manage it. There's ways to move it out of your estate, if you will, into a trust or something like that. So you kind of multiply the 15,000,000 that you have, and you can take pieces of that exemption to plan ahead of time for those taxes. But then there's other taxes, and they're more evasive than even the estate tax, and those are the income tax, particularly just your income tax and your capital gains tax, which that can eat up a large portion of the estate if you haven't set up your assets to get a step up in basis when you die. And what a step up in basis simply means is that you bought it for one price, and you may have held on to that asset for a long period of time. Well, step up in basis means that when you die, you get the basis, the fair market value at the date of death, which erases a lot of the gains that you would have had to pay taxes on. So that's, a very important thing. It happens when people gift things. When you gift property, you give the recipient your basis for that taxes and that tax gain. So that, the difference between gifting someone some property to passing it to them upon your death and getting that step up can be millions of dollars, hundreds of thousands of tax dollars. So, that's very important to have that planned as well. That will erode what you have. We see that a lot of times when the children receive the IRAs, the individual retirement accounts. Those are pre-tax dollars for the most part, and when the child receives them over the next 10 years, they're paying taxes on that as well, which, if it's a saving out of IRA, is gonna be taken out over 10 years is gonna be a big bump in your tax burden. So again, you're eroding a lot of those assets if you don't plan for that capital gains or that income tax on the IRA. Um, so we see those happening a long times. The other erosions are it seems like the last period of your life is like 80% of your lifetime medical expenses. It just all seems to be sometimes in the last 2 weeks, where you just incur these huge amount of medical expenses. And if you don't have the proper insurance and things like that, that will really whittle down and state. We talked to clients who are paying upwards of $15,000 a month to take care of their parents and things like that. And, I don't know how big the estate needs to be able to swallow 15,000 a month. So that can take erode what you're leaving behind to your loved ones as well. So I'd say this regular income taxes, the medical bills, many potential liability. I mean, what if your death occurred because you got in an automobile accident? And now you're getting one of those awards from a jury that are even astronomical that your estate will pay for because it hasn't been protected. That'll erode it. And then the other thing is just that long-term care. Um, if you're, Alzheimer's or you have dementia, Medicare does not cover that. Those are a couple of the illnesses that Medicare won't cover, and so you're now forced to do private pay. And if you think about it, if your medical insurance stops, that's going to really erode your assets as well. For those. Fortunately, a lot of folks living quite a long time in those memory care because they're taken care of, they're fed and all that, and their mind's gone, but their body's still fairly healthy. So those can go years at times in the road state.
Yeah. So, shifting gears to just kind of a higher level question so people can orient to themselves. And one of the things I like about how you work is you kind of put things in a plan structure that makes sense for a specific persona, right? Because everything quote unquote depends when you talk to a lawyer about your situation. So every lawyer is going to say, well, it depends. But that's not a escape. That's not like an escape route for not answering the question directly. There are buckets of people, and this question speaks basically to that. At what net worth or business value should someone stop thinking in terms of what this person calls a simple estate plan, start building a true family governance and legacy strategy? I think I know how you're going to answer that in the sense of you should have a family governance and legacy strategy, regardless of the size of your stuff. Um, and simple is always good, no matter how complex. But there are more moving parts the bigger the estate usually. So you've kind of bucketed things into like a family plan, a family trust based plan, and a wealth, family wealth based type of plan. And talk to us about kind of the minimum buckets of net worth in the family business or in the family estate that would qualify them kind of for the lower end and then the middle and the higher end, as far as kind of what they should be looking at and when they should move off of like a legal Zoom type will or trust and will type thing.
Yeah, sure. So, with a will, where there's a will, there's a probate. And if you don't have a will, you can go through probate. And probate costs different amounts in different parts of the country with the statutory thing determined by the legislature, the parts and everything. And sometimes it's a percentage of your estate that you need to write a check for that amount. Just to be able to open probate. That's even before you pay the attorney or anything like that. And sometimes those are 2% of the estate. So even if you have a modest estate, and you're going to get $1 million home or $1 million with the home included, but it doesn't have a place to go. It's all in the probate estate. It doesn't have a beneficiary or anything on that. The 2% of that, is 20 grand check you're writing, just to open probate, based on the statutes. So if you can get like a trust or something like that, or a vehicle that avoids probate, and you can get that trust for less than that 20 grand, you're already ahead. You haven't wasted the estate or the administration costs.
Yeah, and I think that's a key point because again, you might have other things, but if you have $1 million in assets that are going to either go through probate because they're in a will or not in a will, so mandated, then on $1 million, you're probably looking at $20,000 out of pocket for a plan you didn't write and that you can't control before you can even get access to whatever that stuff is or know what you're gonna get. And so that's kind of the age old thing of an ounce of prevention's worth a pound of cure. The minimum worth question part of this is, if you've got probably $1 million worth of assets in any shape or form, even if the majority of that's tied up in a house and whatever, then the math starts to work against you if you don't have something in place that you designed. And, you can get something in place for a couple $1,000s to $8,000 that would work for most families that have under $2 million work with.
Right. And even using that same $1 million example, if you have that free and clear, after the mortgage and everything else, you sell the house and all your other items and you have $1 million and you have 2 kids, then the question becomes, well, do you want to leave it to the 2 children in a form of asset protected trust for them so that, divide that by 2, each gets 500,000 and, is that enough to protect for them? In other words, if the child has really bad luck or really bad divorce or something like that, they can use the trust that you left them, the 500,000, to start their life over with. Okay. And a lot of parents that we talk to, 500,000 is enough. It's like, yes, I do want to protect that for my children. I wish my parents left me a trust with 500,000 in it that no one could take away from. And still we're just at $1 million in assets with a lot of the family we talk about. That's just their home. A lot of people buy a home, they have a mortgage, but by the time they pass away, they've lived in that house for a certain amount of time and the mortgage is paid off. So if you could protect that amount, that's great. The more kids you have, though, the less they're each going to get of that $1 million. So then you decide differently for that family, and that's pretty much why a cookie cutter, one size fits all trust plan or will plan doesn't work because the math matters. It does depend on what you're trying to protect. You got 10 kids. They each get 100,000. Maybe that's not enough to spend the time and energy to put it into a trust to protect that 100,000. But then you have one child that's $1 million that you're leaving them. Same estate. Now all of a sudden it may make some sense putting that $1 million in a protected vault where their creditors and their predators can't take it away from them. So that's why a lot of people will say it depends because it really does. The trick, though, is to dig into why it depends and to have someone explain to you, why it matters.
So, a couple of things. Net worth is a piece of the equation, but it's not the only piece. If you have a significant amount of assets north of 500,000, you should be looking at putting something in place that you control and that you designed. It'll cost you less than what it'll cost you to deal with probate proactively or reactively down the road. So that's kind of the minimum. The sweet spot, client that we work with is that small business owner slash high net worth individual, but that's in the desert of advice. Like they don't have sophisticated strategies. Maybe the cash flows are not, uh, consistently high enough to go write a huge check, and they have to be thoughtful about it. But at the end of the day, if you have $2 million or more in assets between the personal and the business, then you definitely really need to be taking this seriously. And it starts with the family conversation. And one of the questions that came in that I thought leads us into that, which affects all families, regardless of what the asset transfer may be, but that certainly is probably a more on the mind of the higher end affluent families where there's potentially millions of dollars going to each beneficiary. Um, and so it says, how do you prepare children and or other beneficiaries to become responsible stewards of wealth without creating entitlement or removing their ambition to build something themselves? I would say that before you die, you've probably already done that well or not so well. So whatever you did during life to either enable or create entitlement is probably going to compound in your death. But if you're still alive, you can change that course. And so I think that question is how do you proactively, leave them where they're better off and starting at a better level, but you haven't crippled them unintentionally with some of these things? What have you seen? What do you recommend? What does that conversation look like?
Yeah, and you're absolutely right. I mean, the valuables are usually taken care of with a will or a trust or even the statutes. It says where the items go, the valuables go. But the thing that you need to work with your children, in my opinion, is how do you transfer your values? So we want to transfer both the values and the value. And that's a conversation. And the people that are higher net worth, a lot of them have those family offices where they hire people to help and a team and things like that to make sure that everyone's on the same page, and that team would have people in it like the financial advisor, the estate planning attorney, the CPA, the insurance agent. All those folks would be in there on that same team so that everyone's ideas were together and so that you were forming a plan and whatnot. For the people who aren't the high net worth, the folks that maybe don't have that much, they can reach out to attorneys like ourselves, where we can build the team in the background, but we can help coach them through some of those things. And what does it mean to have a family office and those kind of things? You need to purchase or whatever, but you just need the help sometimes just having the conversations, because you're no longer saying, I want half each of my kids, or I want the business to go to this child. I want the life insurance to go to the other children who aren't interested in the business, or whatever the plan is. But you also want to have the why behind why you did that, because you're trying to maintain family harmony. You don't want to hear them fighting, saying, well, dad loved you best because they left you the business. And because of your hard work, the business is now worth twice as much as a life insurance that we were left, forgetting that it was that sibling who grew the business. But everyone forgets those kind of things when it comes down the road. So that's the main thing, is how do you get those values installed into your kids? And that's why when we brought this up, we were talking about, maybe start talking about what you're investing and why you're investing in those things. What companies do you think are really good companies that are working for this sustainability of the planet, and whatever the family values that you're trying to do. But that's the key, and that's where the conversations have to come from, because a good estate plan can basically get the property equally divided, but it doesn't help the child take care of the property, or you buy a Ferrari. You got to go deeper and figure out what the problem could be, how you can see that ahead of time, and what the philosophy behind the gift is.
Yeah, I mean, good design always starts with kind of the intent of what you're going to use it for. And when you're dealing with multiple generations, the intent that built the wealth may have a lot of elements of what is going to maintain or, perpetuate the wealth, but it also may have some fundamental diametrically opposed views, right? Like what got us here is not what we want to do to keep us going. And those conversations are kind of lead to the next one, which is what assets create the most complications during a wealth transfer. Person said, for instance, closely held businesses or investment portfolios or real estate, private equity, cryptocurrency, or is there something else? I think, some of these questions answer themselves, which is if I went off of your last statement, if you're in a situation where you have mixed feelings about the family business and that's the majority of your wealth, then that probably will be the thing that causes complications, because the plan will tell you how to divide it however. But if the philosophy is not matched, if you built it in oil and gas and your kids are, green energy, like there's going to be a conflict, and that conflict exists now. So, so the creating of complications will only be because you avoid having those conversations before they're something that have to be reacted to. So some of these are obvious. Other ones, are a little bit nuanced. Cryptocurrency could be one, right? It's actually the most easy thing to transfer, but it's also most people have no idea what a seed phrase is. So
Right.
depending on where it's held and who holds it and who set it up, it could be the most complicated, even though from an actual friction standpoint, sending it from one wallet to the next is the easiest thing and permissionless you could do. It's the knowledge base that is probably the gap there that'll cause complications. What have you seen is, you know, the thing that causes
Yeah,
complications?
it's evaluation of the asset. That what makes this most complicated. I mean, it's that closely held business. When they're closely held, they can't be sold very easily. So there's all these types of discounts that you can have for lack of control. If someone just bought, one of the members' interest, you don't want to buy a company where you're only 25% voter or something like that. So it's really difficult to value these businesses. Where when you look at investment real estate, you can pretty much get a value of how much that building's worth, and you could see how much it would cost to get like a company to manage that for you, um, with a property management company. But running a business usually it's got some kind of personal thing, some type of structure. There needs to be manuals on how to take over, because a lot of times the way to run a business is just in an owner's head, and when they pass away, if they haven't got that out on paper or told someone else or taught someone else how to do it, that business quits. So that's the one that's, needs both the care and, like, how much is it gonna be valued? How much is it worth? And how do I keep the continuity and make it worth something? Out of all those, I would pick that one as being probably the most difficult and having the most complications in transferring.
Yeah, and you've brought that up in different contexts over the last couple weeks of these office hours. You've brought that valuation concept up. So there's some good content out there on prior posts around what kind of valuations and for which audience and where do you start with that. So um if the family business, this kind of leads to the fifth one that came in off that post this week. A family business is worth more than its available cash. What are the frameworks, or how should an owner think about executing a plan to create liquidity so that the heirs aren't forced into either a fire sale or a tax situation or an ownership liability that you had mentioned, 20%, like in a lot of states, if you own more than 19%, then technically you're a controlling owner, or you have to list it as something that you own. So depending on how your heirs and you want to equalize or normalize whatever the inheritances are, liquidity is the way that you typically do that. How do you how do you approach it when the liquidity isn't there on the surface and the majority of the wealth is tied up in that closely held business? What's a good place to start, or what are some of the things you got to check off?
Yeah, I'll start with the valuation, the business and what you're trying to give away, and whether you can give stock shares or interest in a LLC, membership interest in a limited liability company. Those you can give that to one person to kind of equalize what you think those shares are worth compared to the other assets and things like that. But another way is just to do what we call an installment sale. And installment sales can be very advantageous to the person selling the business, because they don't get all the cash at once where they have to pay that, tax bill on that gain that first year. It spreads it out over a certain number of years. And as long as the business is making cash flow, and the periodic payments, monthly payments, quarterly payments, whatever you agree to, do not tank the business, that they can afford it, things like that. You can have it spread out over time. And so in the initial split up of the assets, you have promissory notes, that are roughly equal in value, but they're paid over time and things like that to make that more fair. The other way is if the
So
business
almost
activity
structuring it almost like in a pure seller carryback kind of note situation where maybe it's amortized over 8 to 10 years. It can be paid off early without certain interest penalties or something, but you structure it where essentially you're getting control of the business and you're taking back a note, and the seller is carrying that note.
Yeah, and it could be interest only. I mean, it's inter-family a lot of times, so you could say, "Well, I didn't work at exiting my business. I didn't get into it soon enough. So what I'm gonna do is I'm gonna have a 5 years so that I can put in the systems, or have the uh, owner, the people who want to take over, my successors, put in those systems so that there can be an exit sale later down the road. And then maybe that's a balloon payment at the end of that note. So, the promissory notes are contracts, and you can agree to all the terms, and really come up with a lot of different ways. And the other one is when you have real estate. Real estate is usually owned by a separate LLC other than the C corporation or S corporation or whatever. And you can sell the business, but keep the real estate and the payments on that to make your payments over time.
Yeah, and I think a lot of times, I just spoke with a multi generational family. It's built successful business and doubled its size in the last year. And they are a sole prop. So, one of the other things to think about too is just formalizing the structure amongst the family where you take it out of personal names and you put the real estate component into a real estate LLC, and you put members on that maybe are most interested in that, or who that's how you're going to equalize that piece of the estate. And then you put the operating business, whatever it may be, in another LLC or an S corp or whatever the right structure is. And then those members or those shareholders, kind of have that transition there. And then you decide what kind of seller carryback notes or whatever may exist between the parent founders in this case
Mhm.
and the children, and whether that's interest only with a balloon, or whether that's something that ultimately is going to then uh, leave their personal name upon their death and kind of do the step up and basis thing, or whether that's something that's going to be gifted in periodic installments and then needs to be structured in a deferred situation with the LLC. Like, there's strategies there depending on the size of it. But one thing would be is if it's just overly simple right now, like all of it's in personal name and sole prop, then you need to start to put a structure around it that is more coherent with distributing this wealth, or passing this wealth upon the future, retirement or incapacitation or death.
Right, and also look at the expenses of the owner. A lot of people's businesses are financing their lifestyle, and there's a lot of expenses that once the owner leaves the business that do not have to be paid by the business, or potentially. So that can increase cash flow as well. So that some of these can be equalized over time.
So, one of the things that came in was a question from a different one when we were talking about continuity binders and digital emergency vaults, things like that. So many estate plans look great on paper, but they fail because no one knows where the documents are, or has the actual authority. So what is it that you suggest should be in every family's continuity binder, or quote unquote digital emergency vault? What should actually be in there? Obviously, probably a will, a copy of the trust, those kind of things. But what else should be in there that sometimes people forget? And then does a copy of that have to live, or should that live in your recommendation with a third party trustee, like some of the things that you talk about and do? Or if they don't have that, how do they prepare for that with a backup, with a multi person backup?
Yeah, there should be an electronic copy somewhere to answer that last question first, and that can be left with the estate planning attorney or whatnot. Which I recommend leaving it with an attorney because they have attorney-client privilege. Then with your financial advisor, discoverable. Um,
Yeah, I want you to drill in on that for a minute. I know that wasn't in the question, but you and I have talked about that a lot, and I don't think a lot of people understand the difference there. So let's talk about a use case there about why having those documents in the hand of your attorney or a trustee and an estate planning attorney matters when it comes to other things that you might be asked to provide, lenders, creditors, what have you, and the process by which you provide it. So I forget what the use case was you gave me last week, but it was like super crystal clear. Like, because you did this, it's now discoverable if you ever got sued. Because I did it or requested it, it's not discoverable. So some of those nuances are really tactically important, I think.
Yeah, I mean, the attorney is the one that has the attorney-client privilege, and there's a closely associated doctrine of work product. Where we don't have to produce a work product. So if the attorney does a irrevocable trust, and the big reason for getting the irrevocable trust was privacy, so you went to Wyoming or something like that to keep it private. It's The attorney doesn't really have to disclose that to anybody because of the attorney-client privilege. But then when your banker or your financial advisor says, "Well, I need the uh, entire document. I need the entire trust document, not the certificate of trust, which is a two-page document that says that the trust exists, but the entire document, which has your kids' birthdays and all those other things. It takes it out from the attorney, and so when someone sues you, they can list your advisors and whatnot, just so they can get discovery. and go in and grab that trust and know, learn of its existence and those kind of things. So it's very it's very important to, not hurt yourself by giving your information out when you don't shouldn't give it away. And that work was working, with AI and all this kind of you're working with AI with a public database. It flat out says that this stuff is not confidential. We're using all your information to build our database. That hurt. And if you're one of those clients who wants to go home and do everything in AI and you're admitting to the crime, you're asking AI how to defend it. The prosecutor can ask you for that information because you made it public. And it's tough to win a court case when the first thing that you said is, "Yeah, I did it."
Yeah, I was asking Claude about it. Um, yeah, very, very good point. I think a lot of people, but I think what it lends to as well is just understand understand the cost of action and the cost of inaction, right? So the cost of inaction, we gave you one example. If you had $1 million, and depends on the state, not all states are the same, obviously. But if you had $1 million worth of assets and you had no plan in place, you had no will, you had no trust, or the person who owned those assets didn't, and you were potentially one of the beneficiaries or next to kin, that $1 million is now going to go to probate. Depending on where it is, you might write a $20,000 check just to open the probate process before you've seen a dime of it. And if you don't have that 20 grand, or if the estate doesn't have that 20 grand, or you don't have access to write checks on the estate for that 20 grand, then that's coming out of your pocket or that's going on a credit card. And you have no guarantee of how long it's going to take or what you're going to get after the process is all complete. So that's the cost of inaction on a low scale of somebody owns a house somewhere that doesn't suck and had a couple of dollars in a 401k, right? That's kind of the $20,000 cost of inaction. The cost of action is not just the setup and the planning, it's the maintenance. And you kind of have to understand the maintenance is more important than even the setup because to Matt's point, if you're on a billable hour model, it becomes hard. We're all human. We all like I think about like, I'm gonna call my attorney, it's gonna cost me, okay, I gotta keep this to 12 minutes, right? Because every 6 minutes, the thing updates and rounds up, right? So I got to keep this call to 12 minutes. I can't go to 15, right? You don't want to be in that conversation when you're talking about this kind of stuff and you might need to have questions answered or you get asked questions you hadn't thought of yet. And you don't want to be thinking about it through that term, but the attorney needs to make money and they need to be able to provide you the service. And you want that attorney client privilege. And so there's a cost to that. So you want to find an estate planning attorney who's modeled that into their way of doing business, whether it's on a subscription basis, whether it's on a monthly kind of thing, whether it's an annual maintenance fee that you pay once a year, however they do it. But you want to make sure and ask the question of how do you maintain this for me? What's my access to you? What does that look like? What does that cost me? And that should be transparent. If it's open ended, then they're operating from an old world model where they just do the billable hour thing. There's nothing really innovative about that. So they should have an answer for you is kind of number one. I know Matt has an answer because I use them. And so I know his answer. I just think you should ask that question. What does it cost me to maintain this so that I can use you appropriately to prevent these things that I didn't even know about? Like this is discoverable. That would not be same exact outcome, less liability, less risk, less exposure if a predator shows up at my doorstep some
hmm
down the
Yeah,
road.
and if you had if you had an attorney helping you run your family office, they could, going back to your prior question, they can have that continuity plan. They can have the things electronically saved on their documents to maintain that confidentiality. And that's your trust and your wills and your power of attorneys, both financial, medical, birth certificates, marriage certificates, social security cards. All those things are need to be kept. But then, if you have a will-based plan, a lot of wills just say all my rest, remainder, and residue I leave to my kids 50-50. We don't know what rest, remainder, and residue means. So that part has to be in your plan, that you have the bank accounts, what investments with financial institutions, investment portfolios, so that you know what property you're dealing with, retirement accounts, real estate deeds, copies of those. vehicle titles, right? Everything, all that stuff that's rest, remainder, and residue, which could be the entire $1 million of $1 million estate. And then the things that you don't think about a lot of times are the passwords to the wallets or the password manager, the manager key, your email and social media uh, handles that you can get in and turn those off so that you don't live on Facebook forever. Uh, Cloud storage, subscription services, all those kind of things. It's also a good idea to kind of know what your monthly subscription services are because those keep rolling, right? And
Mhm.
you want to turn those off eventually.
Yeah, so there's a lot of questions that could fork off of that. The one that came in that I wanna skip ahead to because I think we haven't touched on this yet, but it's a good centering point. So, if you had your crystal ball, you could make anything happen. You're a magic man. And you could have every potential client, business owner, high net worth family, whoever they may be. They come in, and before you met them, and before they meet any of the estate planning team that they may have around you or work with you, what is the one question that would expose the biggest blind spot in their current plan?
Do you have an estate plan?
So if they have one, what would be the question you'd ask that would expose the biggest hole in it?
Then I'd ask what it was about and whether it was funded.
Okay.
Did it have assets put into it? Or if it is a trust, is it going to work? Uh, but the even bigger one is, do you know how your trust works? You know how to keep it
So
working.
that's the one question, right? Do you know how your trust works? Because somebody might, meaning maybe the matriarch, the patriarch, maybe the person who, took the initiative. Maybe they know. But the spouse maybe 50% knows. The kids maybe 0% knows.
Right.
So I like that one. Like, do you know how your trust works? So first of all, if they don't have one, that's the starting point. But assume they come and they go, "We have one. We did it 3 years ago, 4 years ago." That's going to be common too. A lot of people move a state. Maybe they moved to Florida. Maybe they left New York because they don't want to sell their house to the mayor. Who knows, right? They left for a reason. Maybe they're no longer in California. Maybe they came back to California. So there's like, when was the last time you updated it? Question, have you changed your primary residence since then? There's all those. But then once you know they have one, if you're looking for the biggest blind spot they may have, they're like, we're good, we have a will. We're good, we have a trust. The question you would probe is, great, can you explain to me and do you know exactly how your trust plan currently is designed to work? Because that'll expose whether they know it or whether they just have it. And the big
Another
blind
big,
spot to
another
me,
big
I think
thing
the blind
down
spot, having it
assets.
is yeah, having it isn't enough because having it may be enough, but if you're not certain, having it is incomplete, right? So the blind spot is you think because you have it that you're good, and the reality is that may or may not be true.
Right. And do you have that? Are your assets protected? Do you want to be protected? Are your kids protected from their creditors, their predators? Have you set them up in the basic ways? And are you passing along your values as well as your values?
And what percentage of the time, if you were to guess, I mean, what percentage of the time would you say that people haven't had as much clarity into those last couple simple questions as they thought, even if they have an otherwise well-designed trust? Like, let's assume that their lawyer did a great job and gave them a perfect plan 3 years ago. Um, you know, like you said, it may work, but it may not work for the family because it might work as far as being better than not having one, but it also might be missing a key element of what the transfer is all about. And if the transfer is not just about handing down my assets and my wealth so that my kids are richer than I was when I started, because for most families that's not necessarily the case, right? It's it's about keeping it in the family, whatever that means. It's about giving, your life's work to those who you want to give it to, whoever they may be. But you're also trying to remove the burden. Like, most people that are designing this are trying to not cause the Gen X or the millennial child that is going to have to administer their final years more burden than necessary.
Mhm.
And if you don't have the answers to the questions you just asked around why are we doing it, how does it work, and if they're not clear, you might be giving them more burden, even if you give them a plan that works.
Yeah, yeah. Well, 7 out of 10 people don't even have a plan typically or an up-to-date plan. So there's quite a few people who haven't even really thought about it. And then when you look at it and you do have a well plan because of the lack of communication and these stewardship meetings and things like that, the third generation usually there's none of the wealth left. The kids are pretty good because they saw mom and dad and kind of philosophy. The grandkids get a little bit from their parents, the first generation's children, but then when you get past that, it's gone. So those values, I think, are the hardest thing to pass down. And the reason why we built the wealth in the first place was to do X or to steward this, so we could have money to give to this cause or whatever. That gets lost.
It's also interesting too because, the dynamic of where the majority of this wealth got created in the last 40 years benefited primarily, a generation, which is the boomer generation. But that generation grew up being raised by the parents that were in the Great Depression. So money was not something that you talked about. Like, in other words, there was a different cultural norm between the parentage of the boomer's parent and their parent of the Gen X or the millennial kid, right? And as far as what we talk about, what wasn't. And so you have this kind of accumulation of wealth that is record highs sitting in, mostly boomer hands. They have plans, they have wills and trusts, but 7 out of 10 of them don't have an up-to-date one, so even if they know about it, but they don't necessarily have the dialogue. There's also a lot more mixed families than ever. There was the highest generation of divorce rates, for at the same time, so now you have multiple potential philosophies mixed into this end of life transfer. All of that to say that if 7 out of 10 people don't have it, part of it might just be the overwhelm. Like, they know what to do, but it's like, just don't wanna open up that Pandora's box of conversations. It's human. I can empathize with that. It doesn't solve the problem, but it's an understandable reason to avoid trying.
Yeah.
But at the end of the day, you know, at the end
Or
of the
you have
day,
you have the plan, but no one knows where the documents are, and no one knows what's in the plan. Again, they don't know what you have, and you took the time, you wanted to make it really easy on your kids, so you buy yourself a burial plan. Well, then you die, no one knows that, no one can find it, and your kids are pressed to get something done really, really quickly, so they're going to inevitably buy another one. Probably depending when you bought it, probably at a lot more money, that type of thing. So, those things, it wasn't communicated what you have, where the documents are located, all these things that you need to know. So that's why the conversations eventually.
well, and I think also too, when the conversation is focused on when I die, that's never a fun thing to think about, right? Because none of us wanna die tomorrow, and no matter how old we are, and yet we also know it's inevitable. So sometimes people avoid it just because they don't want to have the conversation, or their kids don't. Maybe their kids don't want to hear, but I don't want to talk about that right now, mom. You're healthy, you're going to live forever. Well, it's like, yeah, but that's not the point. When you start talking about it through the lens of not just family governance, but you know, multi-billion-dollar families kind of get forced into this or not if they're going to preserve wealth because their wealth is so significant that they plan for multi generations because no single generation could spend it all, right? I mean, when you have $50 million, you have to spend 137,000 some odd dollars a day on pure consumption with zero gain to burn through it all, right? Like, that's with 50 million. So, you add commas and zeros to that, you can't spend it all. So you get forced into thinking multi generationally. You get forced into what happens beyond third generation, fourth generation. But we have the majority of wealth right now in families that are first-time millionaires, right? Like, statistically, regardless of whether that's in real estate and stocks or whether it's whatever, and so they don't have, like, that long-term view necessarily of thinking about it through a generational matrix, but it kind of changes the conversation. It kind of becomes more inspiring maybe, if I was to posit that, than when I die, this is what I need to make sure people know. It's like, well, no, let's talk about like what this platform that you helped catalyze can be. Here's kind of my hopes and dreams for what you guys would be able to do, what your kids would be able to do. We can design this together. If you come at it through the lens of boomer and Gen X or boomer and millennial, thinking about how do we design the family platform? It's a shift in the conversation from death and legacy and words that might even not speak to a salt of the earth type of family. And it goes into just like, hey, what if we thought about ourselves as like a continuity stream? And I'm gonna, it's important to me that I have a say, but it's also important to me that you have a say and that your kids will have a say. And what do you think that looks like? How do we approach that? I want to. I'm just thinking out loud of how I think you could shift a narrative so that it maybe gets more than 7 out of 10 to get off the sideline, right? Anyway, thoughts on that as we wind up this session? Any questions in the audience, feel free to throw them in if you're in the live, if you have something specific we didn't cover. Otherwise, I'm going to let Matt have the final word and
Yeah,
close
I
this.
get your thoughts on that. Is what you're trying to do for a lot of parents. They're trying to protect their kids, and a lot of times they're trying to protect their kids from themselves. And that's every parent kind of thinks they want to maybe give a hand up instead of a hand out. So does that mean you're designing your legacy to be a trust that pays 7% of the principal every year or 7% of the income and principal every year so that the trust will probably continue, but the child will never have more than just the 7% to blow on anything? Or do you want to run one of those trusts where you want your child to show up with their W-2 or the W-4 once a quarter to the trustee and have the trustee double what it says on the W-2 because you don't think they're going to work or whatever. But you want to empower them and have them less feel less entitled. And so some of those times when you're empowering them like that, you're putting on all these restrictions that maybe if you had the conversation with them, hey, son, here's what I'm worried about. You could come up with a better philosophy, a better way to manage that, a better vision, if you will, that you could work with that child over time and just see, well, maybe my assumptions that they were just going to spend it all on a car were wrong. Maybe they like being on that private foundation where they get to pick the charity that gets the money and things like that. So there's a lot of, I think, parental things that you're trying to do to, like I say, empower, build a foundation for your kids so they can be successful through life. And if you're looking at estate planning that way, I think you're more likely to get into it and make it.
It's one of the things that's a super practical use case that I think is an example of that is, you are planning for beneficiaries, children call it, and they may be adult children, but maybe they're not married yet, or maybe they are married, but they're not, they're early. Some of these kind of things to empower and protect are this is, a trust set up for you, Matt. And if you choose to spend all that money on your family, great. But if you get divorced, this is not like, in other words, like, here's the restrictions. Like, this isn't a prenup or this. If you want access to this, you have to do these things. Well, the person on the other end of that, again, may not understand the context of why that's being done. And of course, no one gets married thinking it's not going to work. Right. And my favorite line in that show, Landman, if anybody's seen it, is like Billy Bob Thornton says to his daughter at some point, he says something like, honey, every relationship you ever get in is going to fail except the last one. And like when you think about it that way, you go, well, nobody gets into a relationship thinking it's going to fail. But the truth is, only the last one is the one that didn't fail. And so the percentages, regardless of intent, say that, it's probably prudent to think about, well, how is this going to change or not based on who this person falls in love with? And if you don't dialogue that first, how it gets read is, you don't love my spouse, you don't trust. Like, there's all these interpretations that could be extrapolated that don't work well for how you're remembered by your children. Whereas understanding what you're trying to prevent and dialoguing through the ways that that could happen, but still allow for the freedom to fall in love and be with whoever you want to be, those at least help you mitigate maybe the potential misunderstanding that will happen after you're no longer here to have that conversation.
Well, and the parent can set up that protection for their child. And for that protection to work, typically the parent has to die. So the child who doesn't have to share it with their spouse can blame it on the dead parent. There's really it's really not going to ruin any relationship there. So
That's the other way to look at it. That's the other way to look at it is you can blame it on me and I'm gone and,
right.
you have
So
an
that's
out.
another way, empower your children, keep them safe. They're not getting in a prenup or whatever because of love or, all those things you talked about, the high emotions, but the parent can say, you know what, I'm going to take care of my kids. We'll let the parents of the spouse take care of the spouse. So we're just going to keep it in the bloodline. And, we're going to do a good thing for my child. We'll write it in such a way that if they want to screw that up and give it to the spouse, they can. But we're going to at least give them a leg out if that situation happens.
Yeah, interesting. Well, there's a lot of really practical reasons why people should have the conversation. And again, if you are still tuning in and you have joined us later, this was not legal advice. This was a lawyer, Matt, who may or may not be your attorney yet. But if he is not your attorney, this is not legal advice. I am not a lawyer, so this is definitely not legal advice. But this is a conversation to illuminate things that you need to think about and structure properly for and design for and conversation starters. So we appreciate you tuning in again for another AMA and Ask Matt Anything on Atomic Level live office hours. Every Wednesday, we're here, 10 a.m. West Coast, 1 o'clock Eastern, and 11 Mountain. For those who are in multiple geographies, Central, you can do the math there. That's noon Central. And if you are interested in contacting Matt, there's human beings actually over there that answer the phone during business hours and then they call people back during business hours. So they're old school that way, but they are very proficient. Colorado residents can call 970-820-0090. Everyone in all 50 states and territories that is not in Colorado should call 307-463-3600. I want to thank Pebble, who does a lot of my structuring with relationships to how I deal with W-2s and remote workers and things like that. Keeps that part of my structure very seamless. I've been working with them as an EOR for a while now, and they are a subscriber and a Commander Pro level of this channel. So we're appreciative of that. They have special offers for anyone who's looking at using their EOR platform to simplify and optimize compliance around your in-state or out-of-state hires. You can hire in up to 185 countries without any reasons to nexus there or create headaches around compliance. If you want to know more, hipebble.ai, hipebl.ai. Check them out. They're doing deals for people that listen to this broadcast. So anyway, that is it, Matt. Thank you for being here. Final word to you as we wind up Wednesday's Matt Chats.
Yeah, thank you for having me. And I guess my final word is empower your children. Get yourself an estate plan.
Awesome. Yep. Start the conversation. We're putting a bunch of good stuff here on the Shields and Succession channel, conversation starters, playbooks. You've got access to Matt and the team. If you need referrals, we can help you with that as well. Just don't hesitate to reach out, DM, whatever makes sense. But don't be one of the 7 out of 10 families that doesn't have a plan because you don't know where to get started, right? Just get started. Find someone who you can work with that'll kind of customize it for you. Make sure you focus on maintenance and figure out the cost of inaction and the cost of action and just make the relevant, prudent decision. But an ounce of prevention is worth a pound of cure, especially in this case, maybe 10 pounds of cure. So,
With inflation, yes.
yeah, well, and with healthcare costs, right? So with healthcare costs and inflation, it might be 20, 30 times the cure. So just deal with the ounce of prevention is what I'm saying. All right. Thanks, everybody. See you next time.